Good afternoon, investors. You are now on KleverStock with me, Madhavishwari, and I will be serving you the midday roundup with the latest market updates from this morning up until now. Kicking it off with the Bursa Malaysia updates, local stocks dropped below the 1,700-point mark on Monday morning as the global investors panicked over rising Middle East tensions and oil prices climbing above $100 per barrel. The FBM KLCI gapped down at the opening, losing over 20 points in early trade to hit 1,697.94. The market decline follows reports from Apex Research suggesting that fears of a wider war are growing, particularly after US President Donald Trump hinted at expanded military strikes in Iran. This geopolitical risk has sparked concerns about global inflation and energy stability. Apex Research stated against this backdrop, markets may experience elevated volatility as investors assess the potential implications for global inflation and energy prices. The firm noted that while higher oil prices might help local energy stocks, broader market sentiment may remain cautious amid ongoing geopolitical uncertainty and currency fluctuations. The sell-off hit major companies hard, with Maybank falling 18 cent to 11 ringgit 58 cent and Nestle dropping 3 ringgit 60 cent to 102 ringgit 20 cent. However, energy-linked stocks like Petronas Chemicals managed to buck the trend, climbing 1 ringgit 3 cent to 5 ringgit 32 cent. Technically, the market remains in a precarious spot. Analysts believe the overall uptrend is still valid as long as the index stays above the 1,685 to 1,690 support range. Apex Research warned that a decisive break below this level would weaken the technical structure and may signal a deeper corrective phase. The pain was felt across Asia as regional markets faced a bloodbath. Japan's Nikkei plummeted 5.5%, while South Korea's Kospi crashed over 7% as tech giants Samsung and SK Hynix saw their share prices drive by 8.4% and 9.2% respectively. Moving on to our local currency and foreign exchange. The Malaysian ringgit opened on a weaker footing against the US dollar this Monday as the dramatic spike in global oil prices and escalating geopolitical instability drove investors toward the safety of the greenback. At the start of the trading day, the local currency slipped to 3.9550 or 3.9800, down from Friday's close to 3.9425 or 3.9535. The primary catalyst for the ringgit's decline is a massive 37.7%. Weekly surge in a Brent crude oil, which climbed to $107.04 per barrel. This price jump followed significant political shifts in Iran, specifically the naming of Mojtaba Khamenei as the country's new supreme leader, coupled with a drone attack on a water desalination plant in Bahrain that has intensified fears of a regional war. Bank Muamalat Malaysia Berhad Chief Economist Dr. Muhammad Afzal Nizam Abdul Rashid noted that the unfolding crisis has shifted market focus away from traditional economic data. Following the risk-off sentiment, the US dollar index rose 0.52% to 99.496 points. He stated as such emerging market currencies, including the ringgit, are likely to remain weak in the near term amid fragile market sentiment. Technical analysis suggests that the US dollar ringgit pair currently faces a resistance level of 4.0285 ringgit with support of 3.8800 ringgit. While the ringgit struggled against the dollar and the British pound, it showed some resilience against other major currencies, edging up slightly against the euro and the Japanese yen during early trade. Within the ASEAN region, the ringgit's performance was mixed. It gained ground against the Thai baht but saw slightly declines against the Singapore dollar, the Indonesian rupiah and the Philippine peso. Experts warn that with the United States and Israel expected to escalate military responses, global inflation and growth forecasts are being actively reassessed. As long as the threat of wider conflict in the Gulf persists, ringgit is expected to face continued volatility. Now for some economic news. Malaysia's manufacturing sector experienced a notable cooling period in February 2026, with the Purchasing Managers Index PMI slipping to 49.3 from January's 20-month high of 50.2. This dip below the neutral 50-point mark signals a slight contraction, marked by the sharpest rate of job cuts since the height of the pandemic in the August 2020. Industry analysts suggest that the slowdown stemmed from a combination of cooling domestic demand and external pressures, including rising tensions in the Middle East following attacks on Iran. The conflict has pushed Brent crude prices up to nearly 20% to over $87 per barrel, increasingly energy and logistics costs of local producers. Despite these headwinds, many experts believe the setback is a temporary pause rather than a long-term reversal. William Yee, Chief Investment Officer and CP Global FinTech Solutions, noted that the February data was likely skewed by seasonal factors like Chinese New Year. However, he cautioned that a firm recovery has yet to fully take hold. The constructive case for a broad-based manufacturing recovery in Malaysia has become harder to argue with confidence as firms are discounting to stimulate demand. Yee told Starbase, adding that this suggests a sustainable rebound is still in the works. The electronics and electrical sector, Malaysia's primary export driver, remains at a crossroads. While global demand and AI-related chips is booming, much of Malaysia's manufacturing base is tied to legacy segments like automotive and consumer electronics, which are still recovering from excess inventory. Furthermore, a shifting U.S. trade landscape marked by President Trump's efforts to bypass court rulings to impose new tariffs adds an extra layer of execution risk for local exporters. Thomas Young, CEO of Fortress Capital Asset Management, remains cautiously optimistic, pointing out that new export orders actually rose for the second month in a row. He suggested that Malaysia's dip in a unique compared to the broader ASEAN region, which remains in an expansion. Young said February represents a pause and may not represent a reversal, though he admitted the sharp drop in employment warrants close monitoring through first quarter of 2026. Logistical strain is also becoming more evident, with supply delivery times reaching their longest delays in 15 months due to Middle East instability and port congestion. While higher costs squeeze profit demands and margins, some believe Malaysia could paradoxically benefit in the long run, as global firms seek more stable geopolitical neutral hubs to escape volatile regions. Malaysia's standing as a safe investment destination may be reinforced. Continuing with corporate news updates. Paramount Corp Berhad is charting a course for significant growth, with analysts expressing confidence in the group's shift towards greater capital efficiency and more diversified earnings base. Following its fourth quarter 2025 results briefing, the developer revealed a strategic goal to increase its annual pre-tax profit by 100 million ringgit to 150 million ringgit by the year 2030, while aiming to lift its return on equity to 10%. TA Research described these targets as achievable, noting they are underpinned by a robust property sales pipeline and a strategy to sell off underperforming assets. The firm highlighted that Paramount is currently evaluating the monetization of roughly 900 million ringgit in non-core assets that are currently yielding low returns. TA Research noted in a client update, assuming property sales grow at about 10% annually, sales could reach 1.5 billion ringgit to 1.6 billion ringgit by 2030, potentially generating 70 million to 80 million ringgit incremental pre-tax profit. The firm added that recycling capital from stagnant assets into new development projects could further boost profits by 54 million ringgit, assuming returns of 6% to 7%. Paramount has set an ambitious property sales target of 1.2 billion ringgit for the 2026 financial year, supported by a launch pipeline valued at 1.1 billion ringgit and a total remaining gross developed value of 4.8 billion ringgit. Analysts also believe this provides the company with approximately 8 years of development visibility, ensuring a solid runway for medium-term growth. Beyond traditional property development, Paramount is leaning on its 28% stake in the Invictus Food and Beverage Network to broaden its income streams. While its co-working divisions, Core Labs, recorded losses in 2025 due to rapid expansion, management plans to increase its footprint to 280,000 square feet by financial year 2026 to capture the enterprise market. Apex Research maintained a buy call on the stock, citing a 1.5 billion ringgit unbilled sales backlog that provides clear earnings visibility through 2028. The firm remarked regarding the core working division, "We believe the segment's return to profitability will depend on the pace and efficiency of ramp up at a newly opened locations, while remaining constructive on group's overall long-term diversifications." Well, we'll go for a 5 minutes break and we'll continue with more updates. Welcome back to the Midday Roundup. Let's continue with some local news. The Malaysian External Trade Development Corporation is aggressively pushing Malaysian oil and gas services and equipment companies to look beyond traditional markets, targeting high-growth regions such as Africa, Latin America, and the Middle East. The initiative aims to mitigate concentration risk and secure long-term sustainability for local exporters navigating an increasingly fragmented global trade landscape. Metrate CEO Abu Bakar Yusof emphasized that the agency is prioritizing market diversification to help local firms stay competitive. Abu Bakar stated global supply chains are undergoing major shifts and Malaysian companies must adapt by diversifying their export markets while strengthening their technological capabilities. He highlighted that through the mid-tier companies development program and strategic business matching as global exhibitions, Metrate provides the necessary exposure to help local players become global champions. A standout success in this diversification drive is MIR Valve Sendirian Berhad, a local valve specialist that recently secured a contract worth over 10 million ringgit for a subsea pipeline and manifold project in India. The company will supply 48-inch class 300 shutdown subsea ball valves, recognized as some of the largest actuated subsea valves in the world, proving that Malaysia engineering can hold its own on the international stage. The project was executed entirely by local Malaysian talent, a fact Metrate says underscores the high-end technical capabilities of the country's workforce. By leveraging platforms like ADIPAC, the Abu Dhabi International Petroleum Exhibition and Conference, MIR Valve has successfully established a presence in key markets like India, showcasing how strategic state-supported programs can translate into multi-million ringgit international contracts. Up next, we have some business updates. Market observers are bracing for a busy week as several key economic indicators for January and February 2026 are slated for the release. In Malaysia, focus remains on the Industrial Production Index, manufacturing data and employment figures, which are expected to show continued resilience in the face of global headwinds. Bloomberg estimates suggest Malaysia's January IPI will grow 5% year-on-year, a slight acceleration from the 4.8% growth recorded in December. Analysts from trading economists remain optimistic about the broader first quarter outlook, projecting a 3% growth rate of the IPI and a steady improvement in the labor market, with the unemployment rate expected to hit 2.9%. In China, a heavy data schedule will provide insight into the recovery of the world's second largest economy. Consumer inflation for February is forecast to rise to 0.9%, up from a marginal 0.2% in January. Financial institution ING attributed these expected rise to seasonal demand during the Lunar New Year festivities, though it warned that the impact of high global oil prices triggered by Middle East tensions likely won't be reflected until the March data release. China's trade balance also remains a focal point, with year-to-date exports projected to grow by 7% to 9.3%. Despite these gains, producer prices in China are expected to remain in deflationary territory at minus 1.1%, indicating that industry cost pressures persist. Elsewhere in the region, Taiwan is reporting significant, albeit slowing, growth in its trade sector. February exports are expected to jump 35.1% year-on-year, a normalization from the massive 69.9% surge seen in January. Meanwhile, India's trade deficit is forecast to narrow to $28.8 billion for February, down from over $34 billion the previous month, as global trade patterns continue to shift amid ongoing geopolitical and economic changes. Now we'll be wrapping it up. We have major corporate developments and deals across Malaysia. Infrastructure and Energy, Tenaga Nasional is upgrading its grid to support more renewable energy, while EcoWest secured a 54-year concession for the Laluan Istana Kiara Expressway. Telecommunications, Celcom-Digi and Maxis have finalized payments to acquire stakes in Digital Nasional Berhad from the Ministry of Finance. Leadership and Ownership, AirAsia X appointed Tan Sri Jamaluddin Ibrahim as chairman, and Media Prima saw Dato Sri Johari Abdul Ghani's family become the largest shareholder bloc with a 32.96% stake. Strategic Investments, the EPF, became a substantial shareholder in IT Max System, and AME Elite is purchasing 31.8 acres of land in Johor from IOI Properties for 101.2 million ringgit. Corporate Finance, Mr. DIY proposed a massive 5.0 billion ringgit Sukuk program, and Leeform signed a share subscription agreement for 148.1 million new shares. Earnings and Contracts, Gamuda reported a 5% rise in quarterly earnings to 229.5 million ringgit. Meanwhile, Bina Puri Wawasan, Dengkil and Master Tech all secured new contracts in totaling over 169 million ringgit. Legal and Divestment, Leong Hub was granted a judicial review over its price-fixing fine, and Tourism Minister Thiong King Singh exited his 16% stake in Timberwell. Well, that's a wrap for Midday Roundup with me, Madhaveshwari, on KleverStocks. Thank you, investors, choosing us. Stay tuned for upcoming live stream programs.